You've got this great paper on how passive investing is affecting financial markets. So I want to start there. Can you talk about how substantial the shift toward passive investing has been over the last 20 years?
It's huge. So there's different ways to look at it. One way is to just focus on mutual funds, and then you already get, like maybe not 20 years, but let's say 30 years ago, there was virtually no passive mutual funds, and now they occupy something like 15-20% of the market. And I think that's just the tip of the iceberg, actually, because there's a lot more in asset management, in like pension funds and so on that have like slowly shifted away from active strategy. So to give a number, in our paper, we try to just look at how people trade and look who trades like they're passive, and we get something like 40% of the market is passive these days. There's another paper actually that did something kind of cool that looked at like how much people trade on days where we change the indices when we have index composition, and they also find a number like 40% actually. So that would be my best guess, but if I could do 50 or 30%, you would still say it's a big number. So
Yeah. It's a
short
big
answer
number.
is it's big.
Who's the other paper by?
By Chinko and Salmon.
Salmon, yeah, okay, I thought so. We've got Salmon booked for later this year for an episode.
Oh, great.
Can you talk about what an investor's demand elasticity is?
Okay, so that's gonna be closely related to this notion of being passive. So what people call demand elasticity in economics in general is to say, you want to buy apples, I give you a coupon, 10% of coupon. How much more apples how many more apples do you buy? And then for stocks, you can kind of ask the same question. Of course, you never get a coupon to buy stocks at a discount, but it would be something like, if you see the price of Apple is lower by 1% and you have no idea, Apple, now the stock is lower by 1% and you don't know why it happened, how many more shares do you buy? How much more do you invest? And that's an important notion, because that's kind of telling us how investors are leaning against prices in a way, are trying to take advantage of good investment opportunities.
How does the shift towards passive investing affect the demand elasticities of the investors who did become passive?
Also, it depends what those investors were doing before, but it looks in the data like most investors are providing elasticity. So what it means is when they see some stock being cheap, maybe not surprisingly, they tend to buy some. And so if you become passive, you just shut down this mechanism. You just say, well, I'm just going to follow in the index. No matter what happens to prices, I'm not going to trade. And so that just decreases the elasticity that those investors provide to zero.
Okay, that's really interesting. So we did an episode with Ralph Cohen a while ago, and when we talked about similar stuff about how demand elasticities may have changed over time, and he said something related to what you just said, which is that it matters what people were doing before. And you're saying that in your data, it looks like people are becoming less elastic when they shift into index funds. Is that right?
Yeah.
Yeah, interesting. Okay.
So what we know is for sure at the end, once they switch, they're not providing any elasticities. The question is what were they doing before? And so, like the opposite of providing elasticity would be to be more trend chasers in a way, to buy more when the price goes up. And we know some investors do that, but the average institution the typical institution doesn't seem to be doing that.
Yeah, okay, very interesting. What are strategic interactions between investors?
Okay, so that's the part where like these elasticities become a little bit more tricky in a way, which is that how you trade it's not like buying apples in the supermarket in a way. So when you buy apples in the supermarket, it's just, well, I get a coupon. Do I really enjoy eating apples? I'm gonna eat more apples. For stocks, it's really we're all trying to find good investment opportunities. So it really matters how other people are trading as well. If you know that other people are already very aggressive, already taking advantage of investment opportunities, then there's no point for you to be that aggressive. And so that's what we mean by strategic interaction in a way, the fact that you choose how you trade based on how other people are trading. And so it's not really just what you like to do, but how you react to others in the market determines how you trade.
Okay, interesting. So it's like an adaptive system kind of thing.
Yeah, pretty much. I think in economics, people like to say like a equilibrium, maybe. in a way, we adapt to each other, we react to each other in what we do.
Really interesting. And why do strategic interactions matter in financial markets?
Also, because they matter for the stability of markets in a way. One way to think about that is to say, you had a very sophisticated investor, a very active investor that was providing a lot to market, and let's say for whatever reason they wake up one morning, they have an epiphany, they want to become passive. So now they're not there in the market. But what you have to ask yourself, well, is maybe somebody else is going to step in, somebody else is going to replace them. I think this is like looking for $20 bills on the floor idea. This is this idea that there's always somebody on the lookout for more. That would tell us there are very strong strategic interaction in a way. And often we think about this as a very big reason that's for stability in financial markets. But of course, it's just an idea. So the point of our research there was to go and see, does this process happen? Do we see this stabilization? That is, if you change how you trade, Cameron, does Ben come to replace you, or do I come to replace you? Or did we just lose you in a way from markets, and markets are different? So that's why it matters for kind of stability.
Okay, I want to keep going on that line of thinking. What is the expected strategic response to a rise in passive investing in a market with fierce competition?
So if you have this kind of old idea or traditional idea, I would say, of fierce competition, then there would be a big strategic reaction, pretty much a one-to-one strategic reaction. That is to say, there was an active investors, they were providing some information, some elasticity. They leave, just somebody else is going to come to replace them. If they were taking advantage of some investment opportunities, somebody comes to replace them. So they should just offset one-to-one. And that's why, historically in finance, we don't think very much about who's trading, who is doing what, and so on. We have decided that the market as a whole is the unit, is what's stable. And underlying this idea is really this principle to say, well, if somebody changes, somebody else will replace them one-to-one. So that's the starting point in a way. That's what I think the idea a lot of us have in the back of our head.
Yeah, okay. And that's I guess the title of your paper, I guess the premise of the paper is really looking at how fiercely competitive is the market actually.
Yeah, exactly. We just wanted to know, well, I mean, to be honest, we all three of us wrote this paper. We come from this long tradition of efficient market, all this stuff. So it's not like we thought this was a crazy idea, but we just wanted to know, well, can we put our hand on this? Like, can we see this in action, and how big is it?
So if the market is fiercely competitive, how does the rise of passive investing affect asset prices?
Well, the answer is deceivingly simple, actually. That is, it doesn't matter. It does not matter at all, because people become passive, somebody else is going to become active. Again, it's like this magic market. Like, the market is stable no matter what. There will always be the same. So that gives us a simple answer, a simple benchmark, actually. That is that just nothing happens.
So then the next question is how well does that model of fierce competition hold up in your data?
Well, so not as well as at least you might think. So roughly, if you start from this idea that everything should be compensated one-to-one, we find that about 50%, two-thirds, between 50% and two-thirds of these changes are compensated. And so what that means actually shifts, like the rise of passive investing do change the market. So it's like about two investors are leaving from being active, only one replaces them by becoming more active in a way. So that creates large changes, and the market can change over time much more.
And why would active investors be limited in their strategic response?
Well, I mean, I feel not so smart telling you this, but it's hard to trade. It's not so easy. And so, if I tell you, well, one of your competitor has left the market and you want to come in and replace them, well, you have to figure out how to trade. You have to figure out how to identify these investment opportunities. You have to figure out those things. So that's one element. There's another element that is, well, maybe you have a mandate, so you can only do as an institution what you've been told to do, and you can kind of keep going down the line of like there are many frictions that makes that the world is not as easy. First, you have to even know that your competitor has left. When you write theories in finance, and I'm talking from the side of academia, we imagine that everybody knows everything that's going on, but in practice, it's hard to keep track of those things, of who is doing what. And so all this is kind of like slowing down how people react. You can also be concerned about liquidity. If you become too aggressive, then you're gonna have too much price impact. So you don't want to do that either. And so all those forces are gonna tend to like slow you down from reacting to what other people to be very proactive as an investor.
So is it kind of like a limit arbitrage idea?
Yeah, limit arbitrage is another one. For example, it's risky. So sure, you can find ways to get more profit. It's risky as well. Yeah, and so there are many such limits in a way that are out there.
So what role do demand elasticities play in determining equilibrium asset prices?
Okay, so now we started from like each of us has our own demand elasticity. Each investor has their own demand elasticity. If you put all this together, that gets you to the market, and so now that's how you would define demand elasticity for a stock or for even the overall stock market. And what that's telling you is how the market overall reacts when there's a change in price. That's not justified by anything else. So let's say, again, one morning I wake up, I want to sell all my shares of Tesla. That's going to tend to push the price down. Or the demand elasticity of everybody else in the market is going to tell us how the market can absorb this. Are people going to come back and want to buy Tesla a lot when they see the price go down, or not very much? If the market is very elastic, nothing is going to happen, because the moment I'm going to sell, the price is going to drop a tiny bit, and everybody's going to buy a lot and is going to buy from me. If the market is very inelastic and investors don't want to trade, don't want to absorb those positions, then it makes it much more. It's going to create a much bigger change in price, because it's going to take a big discount for other investors to step in. So the elasticity of the market is telling us how much the market, again, absorbs shocks, absorbs selling pressure, or buying pressure. Actually, is completely symmetric. So it's telling us how much noise we can have in the market, and how much volatility we'll have in the market.
So if the market becomes less elastic because investors are becoming less elastic, it becomes more sensitive to trading activity or changes in price?
Exactly. Yeah. Yes. Exactly.
Huh. Okay.
So when there's if we all become less elastic, if there's the same kind of noise, like noise trading, or people moving for whatever reason, maybe life happens, you have to sell some stocks, then the prices will move more in response to that.
Can you talk more about how, you did mention this, but how individual investor elasticities are related to aggregate market elasticity?
That's just the addition. So this part, we can strategically respond to each other, but at the end of the day, we each decide how we trade. And if you add up how we all trade, that's how you get the elasticity of the market. So it's simply an addition, pretty much. Price goes down by 1%. You're going to buy 5 shares. Cameron is going to buy 10 shares. I'm going to buy 2 shares. Well, that means together we buy, now I lost track, but maybe 17 shares. So you just add up how different investors react. So that's why, I was telling you those numbers of like which fraction of investors are passive or active. That shows up big time in those calculations.
Really interesting. So what does the aggregate elasticity of an individual stock mean?
So that means when the price of a given stock, so let's say, we were talking about Apple before. So let's say a share of Apple, when the price of Apple drops by 1%, how much more do investors buy of Apple? So this is the issue of elasticity. It doesn't have to be the same answer as it would be for the market overall. For example, when the S&P 500 drops 1%, how much people buy of the overall market? So I think this is something, for example, Ralph Kojen and Xavier Gabex have talked about a lot, kind of like how the market overall responds. In that study, we focus more on kind of stock by stock. How do people respond to one stock moving, another stock price moving? And so that's where we focus.
Okay, interesting. So you're looking less at aggregate market elasticity and more at individual stock elasticity.
Yes. Yeah, so more so, that it's like, do we have a boom or bust in the overall market? do we start to see different stocks? Again, we don't quite go to mispricing, but in the back of your mind, that's what we have in mind. It's like one stock becomes mispriced relative to another one, or like how do individual stock move more so than the market. That's it.
Okay, so is it relating the individual stock elasticity like relative to aggregate elasticity? Is that
we're not doing too much actually. So we're just trying to figure out how people trade individual stocks. Because if you think about it, as people switch to passive, I mean, there are many changes happening with this, but a big change is how you trade individual stocks. Now, the first order decision when you become passive is say, I'm not going to choose stocks. I'm not going to make decision across stocks. So that means for a given stock, whoever was trying to trade this stock actively is not doing it anymore. For the market, it's much more ambiguous actually, because by becoming passive, now you track the market more actively. You might choose to come in, come out of the market. That we leave aside in the paper. We're more trying to think about how people make decisions for individual stocks.
Okay, yeah, interesting. So how do the elasticities of individual stocks vary in the cross section?
So first, they tend to be not so big. So that's the first result that we found that quite a few people have found as well, actually using different ways. So it turns out, if you think about price impact in a way of like how much the price of a stock moves when you start selling that stock, is quite large actually. The second thing we found, as we are trying to find those strategic interaction, is that actually size matters quite a bit. So somehow large stocks tend to be less elastic, which might be actually quite surprising, because I think we all have in the back of our minds some idea of like large stocks are more liquid, but it goes a little bit into, well, what exactly does elasticity mean? So let me try to take you maybe through that a little bit, because it's something that I find kind of fascinating actually, and it took me some time to wrap my head around this. So I think the reason we think large stocks are more liquid is we think if I sell $100 of a large stock, I'm going to have much less price impact than I sell $100 of a small stock. I would think that's kind of a fact, and that's a fact. Just to be clear, this fact I'm not going to tell you is not true. But elasticity doesn't really think in those terms. It's thinking more in proportion. So it thinks more about like, well, what if I sell 1% of the market capitalization of a large stock? How much price impact will I have compared to selling 1% of the market capitalization of a small stock? And here you start to realize that, well, it could be larger. It could be even much larger, because if you think about large stock, not many people, like many people buy large stocks, but large stocks are large. So it's more about what is the composition of investors. And in large stock, you have a lot of passive funds, like a lot of the big passive players, of course, hold something like the market. So hold a lot of large stocks. So not many people actually are willing to trade against you if you want to buy large stocks, if you want to sell large stocks. Sorry. And so that's kind of how you can see that it could be small. And we went a little bit in the data. We try to see, let's say, within your portfolio. So we zoom out on one institution. And we say, well, within its portfolio, how much does the institution trade the small position that it has versus the large position that it has? And we see the institution change a lot their small position, not so much their large position in a way, because, I mean, that goes back to what we talked about, limits to arbitrage, mandates, and so on, is that if you start moving around something that's like 10% of your portfolio, you move it to 20%, you're completely changing the profile of your portfolio. If something is 1% of your portfolio, you make it 2%, that's fine in a way. You're taking advantage of this investment opportunity, but you're not really changing your portfolio. So there's many things that suggest that actually people will trade less aggressively in large stocks, and the market will be less elastic.
Okay, that's interesting. So the large stocks are held by less people who are less aggressive with their large holdings, I guess, in terms of how much they trade them.
Yeah, so it's large. At first order, large stocks are held more by passive investors. Right? So if you think, the very, very big players like Vanguard, State Farm, BlackRock, they are much more highly represented in large stocks than in small stocks. In large stocks, pretty much they hold the market share. In small stocks, sometimes they don't hold them as much because we have a lot of indices that are zooming in on the larger stocks and so on. So already we have more of those investors, and those players they don't react to prices at all.
Right.
They're not all explicitly indexing, but mostly they don't react to prices. So that means that, again, if we go back to our discussion of elasticity, there's not much elasticity going on in those large stocks. Again, in numbers of investors, many more investors. In dollars, many more dollars. But those stocks are so large that if you sold 1% of a large stock, you will hit too many passive investors.
Right.
So how have aggregate elasticities changed over time in your sample?
So in what we find a trend that goes with the rise of passive investing. So we find that elasticity that have been going down over time. So again, to go back to how we think about it, some of it is mechanical. If we have passive investors, they have zero elasticity. So they're going to make more and more passive investors means lower and lower elasticity. That's part of what happens in our sample, but there's another part actually that we didn't know for sure was going to happen, but that we found, that is, even active investors tend to become less active, have been trading less and less actively, and that trend actually is less kind of steady in the data. So in what we find that actually pretty much up until the crisis, the 2008 crisis, we would see active investors tend to be we're shifting towards becoming more active. But after that, we've seen a decrease in how active investors are trading. So everybody, we have people becoming formally passive in a way, so not trading actively at all. But even the more active investors seem to slowly be trending down. So that's suggesting that elasticities are slowly going down in the market.
Interesting. So it's not necessarily just a story about index funds. It's like active funds are becoming whatever, closet index funds or something like that.
Yeah. So I think there's some closet indexing. There's some, I think there's been more and more discussion of how even active funds get penalized for having poor tracking error.
Mm-hmm.
I think it looks like there's been a shift in the industry towards trading less actively. The one limitation to that, I'd say, and that's something that research is not quite there yet, is if you went to the very, very extreme of activity, you would get hedge funds in a way, or very levered long short investors. And those typically, like in our data, we don't see very well, and we don't really know. So it could be that those most active investors are becoming more active. You would have decided that like firms like Citadel, Jane Street have like more and more sophisticated computers, sophisticated algorithm, whatever happens behind closed doors in those funds. That's possible, but for virtually everybody else, the shift has been to trade less and less actively.
Interesting. What about so you talked about how the large stocks are less elastic than the small stocks. Has the trend, what has the trend in that been like over time?
There's no distinct pattern actually for large stock versus small stock. So everything I described about the markets becoming less and less active in a way is true also in large stocks. Large stocks started less active to start with, so maybe it's a little bit less pronounced, but it's kind of a parallel movement across stock size. So demand for large stock is more inelastic and more so than 20 years ago, but just pretty much by as much as it changed for
yeah, okay. Interesting. So what do you think the implications are of your findings for how passive investing is affecting asset prices?
There's quite a few. So there's some we kind of understand. There's some that are harder to measure or to completely get a grasp on. The simple one we understand is that, it's pretty much the definition of elasticity, is that noise will have a bigger effect on markets. So that would tell us that this shift of passive investing is going to push individual stock prices to be more volatile. That we see some evidence in the data. So we try to look at, if I compare stocks that are more or less elastic, the stocks for which the demand is less elastic tend to be more volatile. So that, I think we have a good sense that it's going to tend to push volatility of individual stocks up. The parts that are a little bit more ambiguous, I would think, is what about information, for example? So something people discuss a lot is, our price is more or less informative. Did we and the way I started telling the stories of elasticity, that often people think about information in a way that is active investors provide information, make prices more informative. So are we losing information? that's really hard to do. So in our paper, we try to look at some measures of information that other people have come up with, and we don't find much. But it's really hard to tell if it's that nothing is happening, that the measures we use are not that precise. I mean, if I ask you guys, like, how would you tell if a price is informative or not? It's really hard to tell. So there's researchers that actually found some pretty clever ways to try to get at that, but it's very noisy. So I'm not quite sure, but I think in terms of concern, that would be the main concern. The flip side of that, though, I think is if you're an investor, in particular a more active investor, it's telling us there might be more investment opportunities out there. And actually, there's this whole idea in finance called the Grossman-Stiglitz paradox. That is, this idea that like, if nobody's acquiring information, then markets are very inefficient, and then you should step in a way. So if everybody's becoming passive, there's more gains for being not passive.
Yep.
And I think what I guess our results suggest is that this is kind of happening in a way that is like, well, maybe there are gains to be more passive and more active somewhere, and there would, of course, again, that goes back to our previous conversation, like, well, why don't everybody become active? And it's hard, it's difficult, it's challenging, but I think this is the flip side in a way, that, well, maybe markets are a little bit less efficient, but there are more investment opportunities.
Yeah, it's really interesting. So that's you drew a distinction there between informational efficiency, which is hard to measure, and elasticity. Is there a relationship between those two things, though? Like, if the market becomes much less elastic, even if we can measure that it's still informationally efficient, doesn't the inelasticity introduce something like noise, or I don't know what you'd call it?
Okay, so it gets tricky. Let me try to take us through that, and let's try to think through this together. So if the elasticity just measures how you react to the price, it doesn't really tell us why you react to the price.
Right.
And so typically we think that if you're more informed, you can understand why prices are moving. And so when you see the price move for no informational reason, you're going to step in aggressively because you know that's what it is. If I'm completely uninformed, I see the price drop, I don't know if it's because there was bad news about the stock or because it's a good deal. So I will tend to not react very much. So that creates this connection, this very natural connection between elasticity and information. That like the active that's why we think that informed investors are more active, is that they get signal, they trade based on their signal. When they see the price move for a wrong reason, they come in aggressively and so on. But it doesn't have to be. I can just be aggressive because maybe I don't know much, but I know I'm just aggressive, I'm an aggressive investor. I'm not very afraid of risk. And so this distinction makes that it's not so easy to know. Now, the other thing you ask in a way is like, well, could the consequences beyond price informativeness matter? I think the answer is yes, but I think it kind of depends even what we mean by price informativeness. So there's two parts in a way. Again, is that one part is the information into prices, and the other part is is only the information into prices. So what I mean by that is there noise as well. So you could have the price moves 1-to-1 when we have a good news, bad news, like these markets are really smart. There's a ton of noise around this. People make mistakes, and so it might be that the information is still there, but that we have more noise, and the noise is bad, of course, because the noise is really risk for investors that come in and out of the market, and so on. So those two aspects might be somewhat independent.
Yeah, makes sense. You explained that. You explained that well. Connected the dots for me.
This is a really interesting conversation. Do your findings support the concept of a bubble in large stocks due to flows into index funds?
So there's been a lot of discussion of that, and I have mixed feelings towards this, and I'm going to give you the researcher answer, that is, we don't really know, which is not very satisfying as an answer.
No.
So so let me try to say more, maybe it's a little bit more satisfying. So what our findings say is they say two things. They say, well, we have more large stocks are not that demand for large stock is not that elastic, and even less so than it used to be. So that's telling us there's a potential flows in like kind of irrational flows into large stock to have a big price impact. That's true. I think another piece of the puzzle that suggests this could happen is that, as we said, the passive investors are tilted towards large stock, so they will tend to come in more into large stock. That's not about elasticity. That's just literally about dollars coming into those stocks. There's more investors coming into large stocks.
Yeah.
There's been a shift away from smaller stocks. If you put those two together, it starts to tell you, well, that's going to push the price of those large stocks up and potentially too much. The reason I'm a little bit unsure is we don't know if that's the case. We also we don't know if the prices were right before. That's the other thing going on. And we don't have a good sense of the magnitude of those flows. So there's a bunch of ingredients that tells you it's possible, and so I think a few years ago people would have dismissed these kind of like stories, and I think by now we have a grasp that this is possible. But have we seen clear evidence of that? It's difficult to tell. It's like if we think about the large stocks these days, it's plausible there's a bubble. I think at least they're very, very highly valued, and they're companies that are very highly valued relative to their output right now, their profits today. Is it a bubble quite yet? I guess it's too early for me to call it, I think.
Right.
So I will not go there. But there are some ingredients that says it could be possible. It's just, I've tried a little bit to think through this algebra, like, well, how many more dollars are coming if I multiply the elasticity, but it's not completely clear to me that it's a very large number.
Does this start to tie into your other research on bubbles and innovation, do you think?
Yeah, a little bit, yeah. So in that other research, in a way, we're more thinking about what starts the bubble in a way. So
right.
In that other work, we're thinking more about people speculating, people having different views on stocks. I think the story today for why passive investing create a bubble on large stock is more we have flow of money into large stocks more just because passive investing invests more into large stocks.
Yeah, I'm just thinking about sorry, I interrupted you. I was thinking about alternative explanations for the valuations of those large stocks being so high right now. It could be index funds, but it could be innovation.
Yeah, so innovation is a little bit of a double-edged sword, I think, for stock prices. Or more, it does two things that go in the same direction, but with different long-term consequences. So in innovation, and that was the theme of this other paper we have on bubbles and value of innovation. So the innovation is good. I think that's the starting point always is that innovation is good, is valuable. And so when we have lots of innovation, we see these firms getting very highly valued. And in recent years, we've seen like Tesla and electric cars. These days, I guess we talk a lot about NVIDIA and GPU for AI, etc. The other side of innovation, and that's what got us thinking in that other paper, was, well, there's speculation often comes with innovation. That is, we want to know who is the winner. And it's like every day we see articles about is like OpenAI going to be the thing we all use, or is it going to be the Google solution, the Llama from Facebook? And so there's this kind of like messiness of innovation that naturally creates speculation. It's like, well, we're all trying to guess or to be informed about who's going to win, and we form views on this. We don't know too much about, 2 years ago, none of us knew anything about AI, pretty much. So,
right.
But somehow today, I bet we all have opinions about which company is going to be the leader in AI and so on. And out of these disagreements come speculation, and bubbles can come out of this phenomenon as well. That would be the other side of innovation, where partly high stock prices because of speculation, and partly high stock prices just because the innovation is good.
And we're going to come back to that in a sec, because your research on that is super, super interesting. We're going to dig into it more. But before we go there, on the index fund, the growth of index funds, what regulatory interventions do you think makes, if any, do you think makes sense to address what's going on with index funds?
The first thing I'll say is there's one dimension we haven't talked at all about, and maybe it's my fault, but the first order fact about index funds is we had a bunch of people investing in like kind of like random stocks and taking lots of individual risk. Like forget about how the market works, just for their own personal consequences, taking a lot of risk, and they're not doing that. As finance, I'm a finance professor. Like what every finance professor has taught for the past 50 years, maybe, is we should all invest in index funds. And so at first order, this is a massive gain of welfare, of like a massive positive of passive funds. So I think, even if work like my research points that there can be other consequences, and some of those consequences might be negative, I think we should not forget kind of the elephant in the room that is for many individuals' life, this has been progress in a way that this shift has been progress. So I think my sense is these questions of regulations and so on, they're not quite yet for today. I think that they are on the horizon. It's like if passive funds become more like, you went, from like 5-10% to 40%, if we go to 60, 70, 80%, this might become a problem. We might see, bigger spikes in volatility. We had GameStop a few years ago, or actually, a few years ago and in the past months as well. Those things might multiply, might happen more frequently, and might become a concern. But I've been thinking about doing research on this to try to know when it's going to become too much. But I think it's hard to forget the part of the trade-off that is just like vast amount of people are just much better off out of more passive investing, and the market might be a little bit different, and that's we should pay attention to that, but that's not necessarily the dominant effect quite yet. It's like I don't think this example of maybe a bubble on large stocks. Of course, if it had a massive crash, could have big consequences. If we saw, if we had a stock market crash that we could really pin on passive fund, maybe. But I think it's way too early to think. I mean, this is not impossible, but it's not very, very plausible at this stage, at least in my mind. And I hope I'm not proven wrong too fast. But yeah.
You mentioned that we hadn't talked about the benefits of index funds yet. I would say that's a key message of our last. This is episode 314 of our podcast. I think that the reason we didn't ask about that specifically is because we've talked about it so much already. So we definitely agree with that message.
And again, that doesn't mean we shouldn't worry about it. And it's very, very important for it's extremely important for the economy that markets work well. Again, we'll talk maybe more about my research on bubble and stuff like that, but it's like, market crashes that are not always look rational are a big problem. Even booms and busts, mispricing, all these things can have big consequences. They can make firms invest in wrong directions and so on. And I think these concerns with passive investing are very, very are meaningful. But I don't think it's quite yet the time for very strong regulatory call based. I mean, clearly regulators should keep track of this evolution. There was, I think a few years ago, there was a proposal to get rid of 13F filings or of the publication of 13F filings. So that we can't tell anymore what large investors are doing or what most investors are doing. I think this type of information is important. Is quite relevant to keep track of. But in terms of corrective action of preventing people from investing passively, I don't think that time has come yet.
So just to finish up on this section, what do you think individual investors should do with this information?
Depends how informed they think they are, I would say.
That's such a good answer.
No, but I mean, again, that comes back to this kind of like two-sided aspect that is like, first you can become passive and that's it. And if anything, that's telling you, because markets have become more fragile in a way for individual stocks, if you don't know too much, you should become more you have even more incentive to become passive than before in a way. And then that goes back to this Grossman Stiglitz paradox, is that at least but from the point of view of an unsophisticated investor, like the more other people are passive, the more markets are are messy and hard to understand, the more value, the more as somebody who's not informed, you should go and be passive. And non-informed doesn't mean, that you know nothing, like just like that sounds like diminutive. It's the people who are very informed in markets are extremely sophisticated. So it's more relatively uninformed. And so, that's saying, the flip side again is there are more opportunities that they might be hard to find, but there are more opportunities. And actually, I think for a long time, we think trading individual stocks is not a great idea. The more I look at this research, the more I think, well, maybe it's not that bad an idea that you focus on something, you try to learn about a stock and so on. Of course, it's not an idea for everybody, and you need to have a way to get information and so on. I don't mean to say, we should live in a world where everybody's trying to pick stocks, but there's something to this in a way, to try to identify situations that large groups of investors have missed, because again, there are just less investors around trying to identify these situations than before. So there's going to be some spots in the market that are profitable. Now, I'm not going to tell you how to find them. I don't know how to find them, but maybe somebody can know how to find them.
Right.
Yep. Somebody's going to find them. Maybe. It's interesting though. Maybe not the active funds. So maybe if index funds are growing, active funds are becoming less active, maybe there are more opportunities for informed individual investors.
Yeah. I mean, look, maybe I should, it's too big of a can of worms to go in there, but like if you think about what happened with GameStop, to me, it's unambiguous that there was a bubble on GameStop and so on, but it's like the short squeeze that happened, this idea that like, a bunch of investors can go and target this short and break this short. Like you could have imagined a few years ago, a couple of active investors do it. And this was something that was led by individual investors. And again, we can have debates on whether short squeeze should happen, whether they should be forbidden. Or like, this is not my point. My point is, this was possible that this happened. And I think if you had asked most people before it happened whether this is possible, I think they would say no way, for two reasons. Exactly. We would have said first, individual investors cannot matter for anything, but we will also have said if there's a good deal to be made there, active investors will take advantage of it. And it didn't seem like that happened.
Yeah, really interesting.